Welcome to Lincoln's Inn. I think some of you are members, some of you are not being members. This talk we do this every year for our junior barrister members, just to help you with a little bit more information about how to manage your finances. We were supposed to have Mason Bloom come from same firm, Silver Levene. Unfortunately, he couldn't come, but so his lovely partner Jackie stepped in, and she's going to give you a really great talk. So thank you, Jackie.
Hi, my name is Jackie Streat. I'm a partner at Silver Levene. We are Chartered Certified Accountants and we're based in Tottenham Court Road, London. I head up the Barristers unit, as you heard, along with 3 other partners, where we look after the accounts, tax and VAT affairs of over 2,000 barrister clients. Oh, that didn't move, but that did. Excellent. Never mind, I'll turn around and look at that. Right, I'm here today to talk to you about your accounting and your tax obligations once you commence your self-employment trade as a barrister. Some of the topics I'll be covering will include the 3 taxes you will encounter, namely income tax, class 4 NIC and VAT. I'm going to talk about the self-assessment regime and your filing obligations. I'm going to go through some of your typical income and expenses that you will have as a self-employed barrister, as well as how your tax is calculated and when it falls due. I'm also going to discuss something called MTD, or Making Tax Digital, which is relatively new legislation that you'll need to abide by when you're VAT registered. And I'm going to end up with a couple of financial aspects. Okay. So HMRC will deem that you have commenced your self-employment trade from the start of your second 6. This assumes that you are able to hold yourself out from the start of your second 6. Regardless of this, you will need to formally register with HMRC for self-employment by completing something called a CWF1 form and submitting this to HMRC. So once you are self-employed, what does this mean? Well, it means firstly, that you will need to start filing annual tax returns for HMRC. And secondly, it means that you will become liable to 3 different types of taxes. Now, the first 2 of these taxes you've probably heard of. They're called income tax and class 4 NIC. Now, what I'm going to say about these taxes at the moment is that they're directly dependent on your self-employment profits. Higher profits, higher taxes, lower profits, lower taxes. And that is why it is so very important that you gather and record as many of your business expenses as possible, because the more expenses you have, the lower your profits, the lower your taxes. And I am going to explain exactly how these taxes are computed a little later. First, let's talk about a tax return. Yeah, what on earth is a tax return? Well, a tax return is a form that you will need to submit to HMRC, wherein you're going to declare all your forms of income. The most important form of income will be your self-employment income and expenses, but other forms of income you may have may be interest you receive on your savings accounts. You may have returns on investments that you have. You may be employed as well as being self-employed at the same time, and we would have to declare your employment income. Other things that you will declare in a tax return are things like gift aid payments that you may have made, or pension payments that you may have made. And why would you want to declare these? Because these will give you money off your tax bill if your top rate of income tax is 40% or higher. A tax return always covers a fiscal year. Fiscal year runs from 6th of April to 5th of April. Filing deadline, the following 31st of January after the fiscal year. And the dates by which you need to make your tax payments that are associated with whatever you've declared in your tax return. Well, there are 2 dates actually. First is the 31st of January following the fiscal year, which is also the filing deadline. But then you need to make a second tax payment by the 31st of July following that January. There are fines and penalties if you violate. There are fines and penalties if you pay late. The later you are, the higher the penalties grow. But as I said, the most important thing that's going to go in your tax return will be your self-employment income and expenses. So what does this comprise? We'll start off by looking at your income. Pupillage award. Any pupillage award that pertains to your first 6 is not taxable. We do not need to declare it in your accounts or your tax return. Any pupillage award that pertains to your second 6 is, and we need to declare this within your income. Now, when it comes to a drawdown, a proportion of that may be taxable, and this depends on the structure of your award. And I think the simplest way to think about a drawdown is, what would I have received in my second 6 had I not taken the drawdown? That amount, that will be taxed. Okay. Other forms of income, fees that you receive from your clients. Also, debiling, if you carry out any debiling work for another barrister, we would also have to declare that as income. Business expenses, thank you. Definition of a business expense is something that is wholly and exclusively for business purposes. Now, note, I didn't use the word necessarily. So, if you've got your eye on a Mont Blanc pen or a Gucci wheelie bag, and I'm not sure if Gucci actually do wheelie bags, but if they did and you wanted to purchase one and use it for your business, that will be fine. You can claim tax relief on it. I'll start by telling you with what is not allowable. What is not allowable if you take a fellow solicitor or a client out for a meal or a drink, this will be deemed to be entertaining, and this is not an allowable expense. So, what are your typical expenses? Biggest one, likely to be your chambers rent and expenses. You may well have some sort of reduction when you first join chambers, but I can assure you this will ramp up as your turnover grows. Other types of expenses, travel. So your travel costs from chambers to courts and back again, and from chambers to clients and back again, is tax deductible, but your travel from home to chambers, your usual place of work, is not. Again, how you travel, this is up to you. You want to go somewhere by first class, this is your choice. As long as the trip is for business purposes, you can get tax relief on it. Other types of expenses, use of home. Now, we would normally put through a use of home allowance within your accounts to reflect the fact that you work from home from time to time, and therefore your utility bills are high. We would use an HMRC recommended amount that is roughly based on average number of hours worked from home. Other expenses, subsistence. Subsistence, this is food and drinks whilst outside your normal pattern of trade. So what it's not is your usual breakfast, lunch, dinner. It's more, if you're out and about, you're going to different courts, seeing different clients, and you get a coffee or a snack, or if you're working late unsociable hours, you grab an extra snack then, or if you stay overnight in a hotel because you have a remote court hearing the next morning, then again, all food and drink at the hotel, as well as the cost of the hotel, will be tax deductible. Motor expenses. If you have a car that you intend to use partially for business purposes, then we can account for your expenses in 2 different ways. The first way is something called the simplified scheme. Simplified scheme is where we give you an allowance, it's a mileage allowance, which is 45p per mile for the first 10,000 miles, and then 25p per mile thereafter. Alternatively, we can bring in all your motor expenses, absolutely everything you can think of. So your road tax, car insurance, petrol, repairs, MOT, car wash, absolutely everything. But then we would prorate these costs or multiply these costs by a business use percentage. Now, there is an official way of working out your business use percentage. So the official squeaky clean, can't be argued way is you would log your miles at the beginning of the year, log your miles at the end of the year, difference is total mileage, and then you would log your miles for every business trip you take. You add up all your business miles, you divide by total miles, and that will give you the undisputed business use percentage. Alternatively, and I would say maybe 98% of barristers do this, they apply some sort of logic, and they might say, well, I think I use my car for business 5 days out of 7, I'll apply 5/7 business use. Or they might say, well, I've got a second car and I use the second car mainly for personal reasons. I hardly use my car for business purposes. 95% business use. Okay. Right, other expenses, your telephone costs, mobile phone costs, cost of the calls on your mobile phone, your home internet, if you use that for business purposes, your home landline, if you use that for business purposes, you can bring these all in, but we would again prorate for business use. And you'll be pleased to know there is no official way of working out the business use of your telephone. Life is too short. You don't need to look at your call log, just apply some sort of logic, some sort of argument to justify the percentage that you have chosen. Other expenses, writing materials, pens, paper, notepads, that sort of thing. Your computer costs, cost of the computer itself, any software for the computer, such as Adobe or PDF Expert. Do you have a home printer that you use for business? You can bring that cost in, any ink for your home printer. Research costs are effectively books that you might buy, Red Book, White Book, Archbold, any law journals that you may pay for, any online research facility like Westlaw. Even if you buy the Times for the law pages, you can bring those costs in. Subscriptions, these are memberships to professional bodies. For example, your membership to the Bar Council, your practice certificate costs, ICO, and there may be many other professional memberships to which you belong. Your indemnity insurance costs tax deductible, our fees are tax deductible. Training and CPD costs, costs of any conferences you attend, overnight stay at the conference, food at the conference, all tax deductible. Court attire. Now, HMRC are quite strict about court attire. So when it comes to court attire, all you can have are wig, gown, collars, cuffs, bands. I would say we could also get away with tunic shirts, so the shirts without the collar, so you can put a detachable collar over the top. But dark suits, unfortunately, are a no-no. HMRC would pull them out were they to inquire. They would argue duality of purpose. They quote some case, Malia versus Drummond, the only one I know, shamefully, and they'd say, you cannot split the personal and the business use of the suit because it keeps you covered, it keeps you warm. So yes. And finally, bank charges and interest on your business bank account, we can bring those costs into. The other thing you should be aware of is that you can go back 7 years pre-commencement, and we can bring into account any capital item that you've already bought for your business. A capital item is something that lasts longer than a year. For example, your wig and gown, a computer, a desk, a chair, things like that, even certain books. Okay, so I would go away and have a little think about that. Okay, I'd have to think about what, capital items you purchase for your business before the start of your second six. And I would do my best to go dig out those receipts and log those expenses, because they will be worth money to you when you commence trade. Okay. I just want to make one other small point. So some of you may be fortunate enough to have relatives, family who offer to buy you a gift, and they offer to pay for your wig and gown, which is really lovely. Wig and gown, it's very expensive. Yeah, it can come to £1,000 to £2,000. What I would say to you, if you've got someone making that offer, I would thank them very much, and say that if possible, you would prefer that they gave you the money and you pay for the wig and gown. And the reason why I say that is because if you pay for your wig and gown, you will get tax relief on it. If you don't pay for it, you won't, okay? And the money that they give you is not taxable, yeah, although it might be relevant to inheritance tax should they unfortunately pass away within 7 years of the gift. Okay, right, so what do we do with all that information? We add up your income, we deduct your expenses, we come up with a profit figure. It is that profit figure that's then used to compute the 2 taxes I mentioned, income tax and class 4 NIC. So how are they computed? Income tax, as I'm sure you already know, the first 12,570 is your tax-free personal allowance. Then your earnings from 12,570 to 50,270, you will pay tax at 20%. Then on your earnings from 50,270 to 125,140, you will pay tax at 40%. Then on your earnings above 125,140, lovely round number, you will pay tax at 45%. The other thing you should note is that once your earnings exceed 100,000, that lovely personal allowance, the 12,570, it starts to reduce and taper away, and you will lose £1 of that allowance for every £2 in excess of 100k that you earn. So by the time your earnings are 125,140, you will have no personal allowance at all. Class 4 NI, how is that computed? Well, the first 12,570, no penny. Then on your earnings from 12,570 to 50,270, you will pay NI at 6%. Then on your earnings above 50,270, you pay NI at 2%. In addition to these taxes, and I am sorry, okay, there are your student loans to contend with. Okay, so you will pay your student loan. Sorry, losing my voice already. You will pay your student loan along with your taxes to HMRC. And then HMRC will transfer the student loan element across to the student loans company. So how does it work? I'm sure many of you are aware. If you have a Plan 1 type loan, you will pay 9% of your earnings in excess of 24,990 to HMRC. If you have a Plan 2 type loan, you will pay 9% of your earnings in excess of 27,295 to HMRC. Some of you will also have a postgrad loan. That means there will be a separate, an additional repayment, and that will be 6% of your earnings in excess of 21k. Okay. I'm now going to talk to you about your tax liabilities and something called payments on accounts. Okay. Yeah. If you've only been employed in the past, you will not have come across these. Okay, so they're quite interesting. I'm going to give you an example. So imagine you have commenced trade on the 6th of April 25. What that means is your first set of accounts will run from the 6th of April 25 to the 5th of April 26. Filing deadline, 31st of Jan 27. And this will be the date when you're going to be making your first ever tax payment. But what are you going to be paying at that point? There will be two elements to your tax payment. Two elements. The first element is the whole of your 25-26 tax liability. So your income tax, your class 4 NIC, and your student loan repayments. Okay. But then there's a second element to this payment. The second element is called a payment on account. It is one of two payments on account that you are going to be making, and it's a payment on account towards the following year. It's actually towards the 26-27 fiscal year. And the size of this payment on account is, it's 50% of your 25-26 tax liability. It's 50% of the prior year's liability without the student loan. Student loans don't form part of payments on account. Okay. Next tax payments due 31st of July 27. What are you going to be paying then? Well, it's going to be a second payment on account. Again, it's towards the following year. It's towards 26-27, and this payment on account is half your 25-26 tax liability without the student loan. We then roll forward. We come to the end of the 26-27 fiscal year, filing deadline, 31st Jan 28. And this is when you're going to be making your next tax payment. What are you going to be paying then? Well, at that point, we work out your actual 26-27 tax liability. Two taxes, student loan. We then deduct the 2 payments on account that you have already made. This will give you something called a balancing payment. Sometimes repayment, for 99% of the time, balancing payment. Plus, you'll be making a payment on account towards the next year, this time based on half your 26-27 tax liability without the student loan, etc., etc. Okay. So what I'm describing to you is quite strange, okay? It is nothing like being employed. You are, throughout your entire career, making these estimated payments on account towards the next year. We're then correcting the position the next year, and then you're making more estimated payments on account towards the following year. Okay. So how do you cope with this regime? How do you cope? Okay. Golden rule, and I'm going to come back to this because I would say this is the most important thing to take away with you today. It is absolutely crucial that you put money aside for tax as you go along. Yeah, from the day 1 start of second 6, you start putting that money aside for tax. Do not wait until you have met with your accountant and then they've told you what your tax liability is before you start thinking about putting money aside. Okay, absolutely crucial. I'm going to come back to this once more a bit later in the talk. There's one other point I just wanted to mention about payments on account. Now, I have described to you the default way of working. Default way of working is that the payments on account are based on the prior year's liability. Now, there is an exception to this rule, and the exception is if in the forthcoming year, you know your profits are going to decrease. And there may be a reason for this. You maybe go on sabbatical, you may go on maternity leave, paternity leave, there may be a reason. In that situation, what we would do, we would prepare a profit projection for the forthcoming year, work out your associated tax liability, and then reduce your payments on account to match. Okay, so there are some exceptions to what I've described. All right, before we move on to the last tax, which is VAT, I just want to touch on something called HMRC inquiry. Now, the self-assessment regime is quite unusual, really. It's unusual because it's a regime where the taxpayer self-assesses or self-declares the tax he needs to pay or she needs to pay to HMRC. Okay. Very unusual. Therefore, it's quite susceptible to fraud. So, how does HMRC police such a system? Well, they carry out something called inquiries. Okay. These inquiries, they may be totally random. There may be no reason why they have picked on you to inquire, or they may be targeted. For example, if your turnover's gone up and your profits have crashed, that might trigger an inquiry. If you are due a VAT rebate, that might trigger an inquiry. When HMRC carry out an inquiry, basically they look into all the figures within your tax return or your VAT return. They ask questions. Yeah, they will challenge you over these figures and they will require supporting evidence. So how do you protect yourself from such an inquiry? The answer is sufficient records. You must keep sufficient records of your income and your expenses. When it comes to your income, your sources of income must be clearly identified. And when it comes to your expenses, every expense, well, as many as you can in reality, must be backed up by a receipt. You must keep your records for a minimum of 5 years following the 31st of Jan filing deadline pertaining to the fiscal year or the tax year in question. Okay. I'm now going to talk to you about the last tax, the lovely VAT. Okay. VAT, it has a separate regime all of its own. At the moment, it is not directly connected with your annual tax returns. It is a system where businesses, such as yourselves, where you gather a tax called VAT for HMRC, which is very kind of you. Okay. And as a thank you for doing that, you can reclaim the VAT that you pay on your business expenses. Okay, so how does it work? How does it work? What you're supposed to do once you commence trade is you're supposed to carry out 2 tests on the last day of every month. Test number 1, you look back at the last 12 months. I appreciate you might not be able to do this initially, but you just go back to your commencement date. You look at your taxable turnover. Has it exceeded 90K? If the answer is yes, you must register for VAT within the next 30 days. This is a legal requirement. This is not a choice. Test number 2, you look forward into the future by 1 month. In the forthcoming month, do I expect to receive a windfall in excess of 90K? If the answer is yes, you must register for VAT with immediate effect. So, once you're registered for VAT, what does this mean for you? Well, it means firstly that you will need to tell your clerks to start charging 20% VAT on your fees to your clients. And secondly, it means that you will need to submit quarterly VAT returns to HMRC. So what goes into a VAT return? You will declare the fees that you have received from your clients in that quarter. You would declare the VAT that you've gathered on those fees from your clients. Then you can also declare the business expenses that you paid for in that quarter and the VAT that you paid on those business expenses. You would then deduct the VAT that you paid off the VAT that you brought in from your clients, and you pay the difference over to HMRC. You have 1 month and 7 days post the end of the quarter to submit the VAT return and pay the VAT. There are fines and penalties if you violate. There are fines and penalties if you pay late. The later you are, the higher the penalties grow. So, VAT, what can I say? Overall, admin headache, quarter on quarter, relentless for the rest of your career. Right. Even more so because of something called making tax digital, which I'm going to come on to, which adds an extra layer of complexity to your VAT returns. But before I completely slate VAT, let's talk about some of the benefits. There are benefits to being VAT registered. And indeed, you may not have a choice because some chambers may compel you to voluntarily register early for VAT. Some chambers might say you need to be VAT registered from start of second six. Some chambers might say you must be VAT registered from start of tenancy. Others will leave it up to you and your level of turnover. But either way, having an understanding of the benefit is always good. So what's good about being VAT registered? Cash flow. Cash flow. You can reclaim the VAT that you pay on your expenses. Now, if you're paying VAT on your chambers rent and expenses, and some chambers charge that and others don't, okay, but if they are charging you that, then that's quite a considerable amount of money that you can reclaim via your VAT returns. Also, there are special rules for your very first VAT return. For example, you can go back 4 years pre-registration and you can reclaim the VAT on any capital item that you have purchased for your business. A capital item, something that lasts longer than a year, a gown, desk, chair, computer. So, you know, when I said, go and have a little think about these pre-commencement capital items that you've already purchased. Well, these receipts, they're precious for 2 reasons. Is one, you will be able to reclaim the VAT in its entirety in your first VAT return, assuming you register for VAT within 4 years of the purchase. And 2, you will get tax relief on the VAT exclusive expense. Okay. Right, other benefits to being VAT registered are that you will look more established. So, for example, if you're not VAT registered and you're not charging VAT to your clients, they may infer that your turnover falls below 90K. So they can kind of size you up, rightly or wrongly. If you are VAT registered, they won't know what your turnover is. So you automatically look more established. And the other reason I would say for registering, I would register earlier than the 90k mark if you had the choice. Maybe the 70k mark. That's when I'd look to register. Because you never want to run the risk of going over that threshold and forgetting to register, because this can be quite an expensive mistake to make. I have had one client, it was a year, a year down the line, he'd forgotten to register. He went over the threshold a year back. And in that situation, you have to register at the right time. If it's a year back, it's a year back. And then HMRC will deem that all invoices that were raised post that registration date, that VAT was charged, and that VAT is due to them. So it can be quite an expensive mistake. Okay. Downsides, as I said, VAT registration, admin headache, fines and penalties if you're late, and more so because of something called MTD, or Making Tax Digital, which is relatively new legislation that you will need to abide by if you are VAT registered. So what does it mean to abide with MTD? Well, it means firstly that every business transaction will need to be stored digitally. That means for every bit of income and every expense that you have, you will need to store in some sort of software, date, amount, VAT elements, description. Okay. And secondly, it means that you will need to submit your VAT returns using MTD compliant software. Examples of this: Xero Cloud accounting software, QuickBooks bridging software, Sage Cloud. There are many pieces of MTD compliant software out there on the market. This software costs money. It has a license fee associated with it, compared to the lovely, simple, free interface that HMRC used to provide for VAT. This has now been completely withdrawn. Okay. I just want to make one further point about the lovely Making Tax Digital. It is coming into place in phases. So first phase where it affects VAT is in full force, but the next phase is coming into place in April 26. And from that date, MTD will affect income tax as well. So what it means is for income tax purposes, every business transaction will need to be stored digitally. And moreover, you will need to file quarterly profit and loss reports. This is aside from your VAT, okay, separate to your VAT, quarterly profit and loss submissions to HMRC, along with a fifth submission to merge the four plus your tax return. At Silver Levene, how do we deal with MTD, with its compliance? We use Xero Cloud accounting software, and we give our clients an app. It's called Dex. So Dex, basically, it allows you to snapshot your receipts on the go. And not only a picture of your receipts, but also the numbers on the receipt will feed through into your Xero account, ready to be processed for VAT. Dex is also quite clever. So, for example, it can hook up to your telephone provider and pull down your telephone costs. And Xero itself can hook up directly to your business bank account, which means that it will be able to pull off all your individual transactions within your business bank account on a real-time basis. Okay, that is VAT. I'm now just going to come back to the golden rule. Golden rule, most important thing to take with you today, take away with you today. You must put money aside for tax as you go along. Absolutely essential, right? If you haven't done this already, I would suggest that you do a little bit of research. You find yourself a lovely high interest savings account. You open it up, call it your tax account. And then from the start of your second six onwards, I would recommend that you transfer between 25% to 30% of your fees received, including any second six pupillage award. And I would make regular transfers into that tax account, ring fence it, do your very best not to touch that money, until your accountant tells you what to pay. Okay. If you do that, you ought to have sufficient monies to cope with those payments on account, so that when you are sitting opposite your accountant and they are telling you what to pay, you are sitting there feeling very comfortable indeed and thinking, yes, it's all there, just sitting in my tax account, not a problem. When it comes to that, I would just think about VAT as it's not your money. It's the best way to think about it. You're gathering it for someone else. So that 20% VAT, I would put it straight aside into a separate bank account ready to be paid for your VAT returns. Okay, and now I'm going to touch on just 2 small points before we finish. I'm sorry about that. Pensions. Just so you're aware about pensions, why are pensions good? Aside from saving for your retirement, which I know seems a long way away, why are they good? They're good because there are tax benefits to be had. So I'll give you an example. If you put £800 into your pension in a particular fiscal year, what's going to happen to that £800? Well, the first thing that will happen is that the government will top up your pension pot by £200. Yeah. The government make the assumption that that £800 is actually £1,000 of untaxed income, or sort of taxed income at 20%, and they give you that 20% back straight into your pension. But the other thing that will happen is that you will get a further, no, if your marginal rate of income tax is 40%, then you will get a further £200 off your tax bill. £200 of your tax bill. That's 25% return on £800. That's pretty good. And what's effectively going on here is you're getting all the tax back on that £1,000. You're getting it all back. So if you're 40% taxpayer, you're getting £400 back, 200 off your tax bill, 200 in your pot. Now, there are all sorts of rules regarding pensions that change every year. At the moment, you have an annual allowance or a maximum amount that you can put into your pension in a year, which is currently 48k net, topped up to 60k by the government. But when you become a high earner, so when your earnings exceed 260k, that annual allowance starts to reduce and taper away. So by the time your earnings are, it's 360k, your annual allowance tapers right down just to 8k. Yeah, that's all you can put in. And at that level, you probably wouldn't get out of bed for 8k, right? But if you have a pension open 3 years prior, then you can carry forward any unused pension allowances from those 3 prior years. Okay? And that will allow you to pay a bigger contribution into your pension, bigger than the 8k net. But this will only apply if you have a pension open in the 3 years prior. Therefore, opening a pension might be something you ought to think about sooner rather than later, so that when you do become that high earner, yep, you are set up and you can utilize those unused brought forward pension allowances. Because what you don't want to happen is for you to get to that level, yeah, earn your 360k, go to your accountant and say, well, you know, I've got loads of money now, I want to put this huge amount into your pension. You don't want to be told, well, actually, you're just confined to 8k nets. That's all you can put in because you didn't have a pension open in the 3 years prior, so you cannot carry anything forward. Okay. And last point, just to touch on, is income protection. So I'm sure many of you are aware that if you are unwell, and I'm sure all of you will be well and healthy, but if you are ever unwell, yeah, there is no cover if you are self-employed. It's not like being employed, right? If you are off work because you're unwell, say for a 3-month period, you probably wouldn't even notice the money initially, because what will be happening is your age debt will continue to come in. So you wouldn't feel it. The time you will feel it is when you return to work. Okay, and you're working away, and all that's happening is you are raising fee notes, but no money is coming in. That's when it's going to hit. Okay, so it may be worth just having a little think about taking up some sort of income protection insurance to protect you against this situation. Just so you know, unfortunately, the expense that you pay, the income protection insurance cost, is not tax deductible because it's personal. Okay. All right. So I'm just going to finish up, just letting you know about our first year free offer that we did to new pupils. We do understand that it's quite financially difficult in the first year. So what does our first year free offer cover? It will cover the preparation of your first set of accounts, preparation of your first tax return. It will cover registration for self-employment and registration for BET. There will also be an annual meeting with a partner where we sit down and we go through your accounts with you, mainly to make sure you haven't missed any expenses out that you could actually claim for, and also to discuss your tax liability. First year free offer is conditional upon 2 criteria. Firstly, that you provide your information to us in a timely manner. And the second criteria is that you are receptive to us continuing to act. Okay, thank you for your time.
Yeah. Thank you very much, Jackie.
Sure.
We have a little bit of time to take some questions, if that's okay.
Okay.
So if you are joining us online, please feel free to drop them in the Zoom chat. If you are in the room and would like to answer a question, I do have the mic here. That's only so that people online can hear the question and the answer. So I'll take one in the room first if anybody does have a question.
Can I just ask you to reiterate the point about the drawdown at the beginning?
Yeah.
I didn't quite catch it.
The drawdown, yeah. The simplest way of thinking about a drawdown, what would you have received in your second six had you not taken it? And you can see that from your contract with Chambers. Yeah. So yeah, does that make sense?
Yeah.
Okay, it's the easiest way of describing it. I can describe it in other ways, but I think it would just be more confusing. I find that simplified.
We've got a question online and then I'll come back to the room. Someone has asked, is it worth incorporating as a company or should they stay as a sole trader?
Okay, you can incorporate as a company because quite a while ago, the Bar Standards Board, they allowed it. And at that time, we were ready actually to go around Chambers and advertise all the benefits of incorporation. But shortly after that time, the government changed the laws, or not the laws, but the way that dividends were taxed. And when you are incorporated, one of the main ways you would take money out of a business would be via dividends. They increased the tax on dividends. And therefore, we found that it wasn't necessarily tax efficient to incorporate. Okay, there are pros and cons to incorporation. If you were thinking about it, the first thing you'd have to do is check whether your chambers would allow it. Okay. But are there benefits to incorporating? There may be benefits if you don't actually spend your money. So if you leave it in the business and you don't spend it, then you would initially just pay tax at corporation tax rate, which may be 19 or 25%. And then you wouldn't pay tax until you took money out, yeah, in the form of dividends and typically a little bit of employment income to cover your, tax-free allowance. Yeah. So overall, we have found, well, out of 2,000 clients, only 2 have incorporated.
Yeah.
Well, firstly, just to follow up on the drawdown questions,
Yeah.
might be too technical, but if your chambers didn't specify how the drawdown was going to be paid, do you just assume that it would be sort of split up in 12 equal installments?
Okay, so if your first and second six, if it was split 50-50, yeah, and it didn't say how it was split, you could assume, yeah, that if you didn't take the drawdown, that the amount would still be split 50-50. And the upshot would be that 50% of that drawdown was taxable. Yeah, along with your second six payment, 50%. The time it's taxable is not when you receive it. It is taxable when you prepare your first set of accounts. Yeah, it's at that point. It is not when you receive it. So please don't think you have to prepare a tax return and declare that drawdown. Yeah, don't.
Great. And then, sorry, just one more question, if that's
Yeah.
all right. What are the different like accounts that you would recommend that we have? So I know you mentioned having a separate account for
Yeah,
your VAT,
yeah.
and then one for the
Income tax.
Yeah.
So yeah, main income tax account that will cover income tax, NIC, and your student loan payments. That's one bank account. One bank account for your VAT. Yeah, these are basically savings account, which all you're doing is moving money in and then paying occasionally money out. That's it. Nothing else is going on. Possibly a third bank account for your business transactions. You are not obliged to have one, yeah, but it helps because it splits off, it separates out your personal expenses and your business expenses. So it's easier for you to track them and record them.
Hello, thank you. It might be a stupid question, but at what point do we need to be bringing in an accountant? Is it prior to pupillage or prior to second six? What do you recommend?
Yeah, I will come to your accountant shortly before start second six.
Okay, before second
That's
six.
yeah, before start second six. Yes, especially because a lot of you, well, I have found that a lot of you come to me panicking because they need to be VAT registered.
Yeah.
From start of second six. And it can take a while for your VAT number to come through.
Okay.
So really sort of 2 months prior.
Okay. Perfect. Thank you very much.
So yes, now, if you're in your first two. Any other questions in the room? I'll just go over here.
Just on the point that you made about payments on account for self-assessment.
Yeah.
In the event that you are taking a sabbatical, for example, from practice, for whatever reason, paternity leave, for example, how would that work? Is there a way to let HMRC know that? And, what would be the practical implications of that?
Yes. So as I said, what we do if we know your earnings are going to go down is we prepare a profit projection, for that forthcoming year. We work out the associated tax liability for that forthcoming year, and we reduce your payments on account to match that liability. And we do that, we can do it in two ways. One is within the tax return itself. We can declare that we've reduced them and we put a reason for it. But we can also reduce them outside the tax return. So if subsequently, if you've filed, and then your income is going to go down subsequently, you can still reduce outside return. We don't need to amend return to do it. We can do it from our own system. The downside to reducing is you just need to be a bit careful. So if you over reduce and your liability proves to be higher than what you've reduced your payments on account to, then interest will be due on the underpaid payments on account from the dates that they were paid.
Thank you very much for this talk. I was wondering whether you could speak a little bit more about income from interest on money in bank accounts, and specifically with an eye to putting aside money for tax, how we might take account of the money that we have sitting in bank accounts, including to pay tax.
Okay. Interest needs to be declared. Interest on all bank accounts need to be declared on your tax return. I've got to think about my rates now. But if you're a basic rate taxpayer, you can have £1,000 of interest tax-free. Yeah. If you're a 40% taxpayer, you can have £500 of interest tax-free. And if you're an additional rate taxpayer, you can't have any interest tax-free. You would pay tax on it. Okay. The interest just adds on to your profits. Yeah. And the whole lot is taxed in the way I've described it, although there's no NIC class 4 on interest. There's just income tax.
Just a question online. Leading on from the class 4 NI. Someone's asked, does class 4 NI entitle you to a state pension?
Yeah, well, Yes and no. You need to have, I believe, 35 years of NIC payments to qualify. This is for the maximum state pension, but 35 years. You can look up your records at any time. If you go to Government Gateway, you will be able to view your NI records. So you can see sort of how that's going along and whether there are any gaps and whether you may want to make voluntary NI payments to make sure you've got those 35 years and therefore you qualify for the maximum state pension.
One question in the room. We've got one more online. So somebody has asked, if the person is self-employed but also receives money from employment, i.e. judicial equipment, can they receive tax relief on expenses occurred in the course of their employment, so in the employed role? Or is that only limited to expenses relating to the self-employment?
No, unfortunately, expenses relating to your employment, related to your employed role, they are abysmal. They are far and few between. Can I even think of one? If you're employed, I believe you can get tax relief on any memberships. So, for example, your ACCA membership, my ACCA membership, I could get tax relief on that many years ago when I was employed. Okay, but they are far and few between. You cannot just offset them. You certainly can't offset them against your self-employment trade. No.
I'll just do one last one online. Someone has asked, can you get tax relief on an electric vehicle?
Yes. So if you buy a car for your business, yeah, especially if it's new and if you buy a car for your business, you can claim something called capital allowances, which is a form of tax relief. And the amount of tax relief you get varies depending on the CO2 emissions of the car. And if you buy a new and electric car, then you get this amazing allowance, which is 100% of the cost of the car in the year that you buy it, prorated for business use. It's called first year.
Lovely. Okay. Oh, we've got one last one in the room.
Thank you. Would Silver Levene's offer to new people barrister clients cover earnings from sources other than pupillage?
Yes, it would have to cover all your sources of income. Yeah, because we're obliged to put it. Yeah. What other sources do you have?
Possibly some writing.
Yes. Yeah, that would have to be declared. Yes, under the tax code.
Okay, lovely. Well, I'm sure you'll all join me in thanking Jackie so much for such an informative talk. We will be sharing a recording of the talk and the slides. I know it's quite information heavy, so you'll have a chance to look through those again. Otherwise, I just want to say a big round of applause for Jackie for that.